Over the IRS Interactive Tax Assistant tool that helps taxpayers determine whether or not they can claim a deduction for student loan interest. So, for your general awareness, certain eligible taxpayers can claim student loan interest as a top of the line or above the line tax deduction on Schedule 1 of their tax return. In other words, they don't have to itemize deductions if they're able to take the student loan interest. This would be an adjustment to adjusted gross income, or AGI, as opposed to a deduction from adjusted gross income or from AGI. So this tax tool allows people to walk through, and if you are under a certain income threshold, then you should be able to claim a deduction on Schedule 1. So you're going to need some information for this. You're going to need to know your tax filing status, whether you're single, married filing jointly, married filing separately, head of household, or a qualifying widow or widower. Some basic information about your income, your adjusted gross income, and then what educational expenses that you paid with non-taxable funds. So this tax tool is estimated to take about 10 minutes. So we're going to go ahead and get started and walk through this interactive tool. So let's go ahead and begin. So we're recording this in the 2023 tax year. That means the most recent tax year information available would be from 2022. However, I would also add that there haven't been very many major changes, so this would be a decent proxy to help you determine what you could possibly deduct on your student loan interest. And when you're updated in 2023, the answer shouldn't change too much. So the first question, we did select the most recent tax filing year, which would be 2022. We're going to indicate single taxpayer as your tax filing status. And then now, who was obligated to pay the interest? Was it you as the taxpayer, or was it someone else? So if someone else is legally obligated to pay the interest, let's see what the tax tool says. So you can only deduct interest on a student loan if you are the one that's legally obligated to pay the interest. For example, if your parents took out a PLUS loan and they're on the hook for your student loan, then you would not be able to claim the interest even if you actually paid it. So let's go forward with you. So modified adjusted gross income. There are different meanings of this term depending on what situation you're in. So let's take a look at what modified adjusted gross income means for student loan interest deduction. So generally speaking, the modified adjusted gross income, or MAGI, is your adjusted gross income before you take any deduction for student loan interest. So basically, it's your AGI, except you would not be taking the student loan interest. You would leave that in there. So let's just say that your student loan, your AGI is $80,000 a year. So now, the next question is, was the student loan from a related person or a qualified employer plan? So let's say no, most student loans are not from either of these situations. So let's just say, have they been refinanced, consolidated, or collapsed? Like, have you refinanced your loans or consolidated them into one loan? So if you do refinance for more than your original loan and you don't use the additional amount for educational purposes, then you can't deduct any of the interest that what you paid on the refinanced loan. So if you refinance a loan to, pursue that 5th year of education or to go for your master's degree, then yes, you could. But if you refinance a loan and then you just added some other things like I'm going to consolidate my credit card debt, then you can't take that interest. So be very careful if that's a decision you're considering. because you wouldn't be able to deduct that interest. So let's say no. So we're going to say that you are the student. You're doing this on yours. You can't. Let's just say that you're out of college and you can't be claimed as a dependent on someone else's tax return. And then at the time these education payments expenses were paid, let's assume that you were at least half-time enrolled in your college. And then was the student loan taken out to pay solely to pay qualified educational expenses? We'll say yes. And I'm going to stop right here just to kind of highlight this fact about the blue highlighted fields. So anytime you're in the interactive tax assistant and you see this blue highlighted text, that's where you can click on it to get additional information. And they put pages from the various IRS publications. This is directly from publication 970, Tax Benefits for Education. And this is a list of qualified education expenses. So tuition and fees, room and board, book supplies and equipment, and then other necessary expenses. The cost of room and board only qualifies to the extent that it's not greater than either the allowance for room and board determined by the college that you went to, that was included in the cost of attendance, or the actual amount that you paid if you were living in student housing. So were these educational expenses paid with the federal post-secondary education loan? Were any education expenses paid with non-taxable funds? Let's take a look at what non-taxable funds would look like. Could be employer-provided educational assistance. Could be the tax-free distribution from either your 529 plan or a covered out education savings account. It could be savings bond interest that you excluded from income. There's a tax form. We'll include the note in that for or the link to that article in the show notes. There's the tax-free part of scholarships or fellowships. So all of this is tax-free, education benefits or payments. So anything above and beyond that, let's assume that you didn't use any of that and you paid for everything either out of pocket or through student loans. So what was the amount of student loan interest? Let's just say we paid $2,000 of interest. Would it be either deducted somewhere else on your tax return or excluded under a distribution from your 529 plan? Because the IRS does not allow double benefits. So you can't take a tax deduction that you're already taking somewhere else on your tax return, like employee-related business expenses, on Schedule C, for example. Were the education expenses paid or incurred within a reasonable time frame? Were they dispersed within 90 days of the beginning or the end of that academic period? Were they for a specific academic period? So then, in this case, you can claim a deduction for the year that your interest was paid. The amount of your student loan interest deduction is gradually reduced as your adjusted gross income goes higher and higher. So the most you can deduct in any 1 year is $2,500, regardless of how much loan debt you have, how much interest you paid. But because it wasn't part of a post-secondary education loan program, if they weren't dispersed within 90 days, if they weren't for a specific period, you'll need to keep all of your records. You really should keep all of your records anyway, just in case. Speaking of records, what you should do, in addition to all of the above, is take a close look at the review screen. And you can see at the very bottom, there's a print button. You can print this. What I would encourage everyone to do that's using this tool to help make a decision is take a look at the review screen, print it out, and go over it line by line. These are the questions that you answered that got to this point in the screen. And what you're looking for is any mistakes, any hiccups, anything where, oh, I need to go back and change this answer. So let's imagine, what would happen if you took a student loan from a related person or a qualified employer plan? Would that change the answer? Well, let's take a look. So we're keeping all the other answers the same. And there's a difference. In this case, you can't claim a deduction because it was from a qualified employer plan or from a related person. So it does not meet the requirements. So as I mentioned, what you should do is go through each of these answers line by line. And once you are fully satisfied that the answers that are on your screen are the answers that reflect your situation, print that out and keep that in your records for tax purposes in the case you're audited. That way, when you are having a conversation with the examiner, you'll be able to pull this up for quick reference and walk that person through the process that helped you determine whether or not you could deduct that student loan interest. So that's what I recommend. I recommend this for anyone that uses any of these tax assistant tools because this is not tax or legal advice. This is simply an automated tool. It doesn't keep any of your information, so none of your records are reflected. And the only documentation that you have is if you print the screen out. So we'll post a couple of links to other related articles and videos that we've produced on our in the show notes. And there are articles we've written about some of these related topics. We'll post those links in there, or you can go directly to our website. If you go to teachmepersonalfinance.com, you can type in a tax form. You can type in Schedule 1 to see what that looks like. Odds are, if you're interested in a tax form, we've probably written an article about it. So feel free to go to the Teach Me Personal Finance website, go to the search bar, type in the tax form that you're looking for, and you'll probably see our article. If you like our articles, please subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our YouTube channel. And if you have any questions, comments, or if there is a topic you'd like me to discuss in the future, please hit me up in the show notes. Thank you very much and have a great day.